All right, welcome to the Aeromir Roundtable. Today is the 4th of September, 2025. So welcome. Special friend, Scott Ruble from Stratagem Trade. Scott and I have known each other for quite a few years now, and Scott's always got really great information. He's a super experienced floor trader and does a great job with his pot class every week and great classes and workshops that he's got over there at Stratagem. But today he's going to tell us a little bit about jelly rolls. So, Scott, welcome. It's always a pleasure, and I'm glad to have you back.
Oh, thanks for doing this and thanks for having me, Tom. I think everybody appreciates all the hard work you put into what you do. We're going to be talking about jelly rolls today, and it's kind of a serendipitous story of how this even came about. But let me get started before I even open my big mouth and just remind people that Tom and I both have disclaimers that we got to give out so that the lawyers don't beat us up.
Basically, trading's dangerous. Look both ways before you cross the street, right?
That and we're incompetent, so don't listen to us.
There we go.
Okay. So, um, but as always, Tom, I want to thank you and for all the hard work you do.
Oh, likewise.
Um, there's plenty of stuff. Most of you guys have seen me before. If not, you can go to our website and see all our stuff that we've done. And we're in stocks and commodities this month. So
All right,
talking about,
really
yeah, talking about the Viper. Well,
nice.
actually, we're not. A guy named John Sarkett.
Oh, I know John. He's written some articles with me too.
Yeah, he's an unbelievable writer. He's great. He's like the rock star of trading writing, and um he saw us do a Viper once and wanted to write up about it. So
Oh,
if
nice.
this is back 3 months ago when the volatility was high
Right.
and and but the magazines had their schedule and it took 3 months to finally get in. But it's on newsstands now if you want to read it. And we're going to be talking about the Jelly Roll specifically because we're having a 1 day mini class with a bonus class coming up on the 13th. And this isn't even something I really wanted to do or even thought about doing. It was just something that the students saw me do 3, 4 months in a row and said, we got to learn this. But it's a little bit complicated. There's a lot of moving parts. And so it's not something I can teach in like a 90-minute 1 or 2 hour pod class. But the jelly roll, people don't realize, is a term that's been around since the 80s. It's just essentially rolling synthetic stock from one expiration to another. And in its most basic terms, it's just a time spread between the SPX morning and afternoon expirations. Every third Friday of the month, the SPX has a morning and an afternoon expiration, and the jelly roll is designed to take advantage of that weird little phenomenon that occurs. So, what is it and what do we do with it? All that stuff, that's what we're going to be talking about for the next, say, 20, 25 minutes. I think the slides are pretty self-explanatory on at least the overview, but to go into the minutia takes a long time. Some people have probably heard about program trading or basket trading, and it's really what keeps the markets efficient. Now, Alan Greenspan blamed program trading on the crash in 87 because he didn't want to admit that his raising interest rates was the effect. But um, it proved to be disproved. It proved to be false. As a matter of fact, basket trading or program trading actually kept the markets from going even crazier because it's an arbitrage that keeps things in line and from getting too crazy. And specifically, what it is the difference between the SPX, which is the S&P 500 cash, and the S&P futures or the E-minis. Now, what you're looking at here is a graph between the SPX cash and the S&P futures. And you see that they just move in alignment, but there is small convergence and divergence between them. Many people will watch CNBC in the morning and hear about fair value and stuff like that. Now, the last jelly roll we did, the fair value was about 22.47. And as we get closer and closer to expiration, which is the September expiration, that number gets smaller and smaller and smaller until they eventually meet. But at the time we did the last jelly roll, it was about 22.47. And what does that mean? Essentially, when news hits the world, the first thing that moves instantly is the S&P futures. All the programs, all the black boxes, the machines that read the news and start spitting out buy and sell orders go into the futures because they're the quickest, easiest thing to execute a trade on. And you will see the futures move instantly, and then it takes a while for the cash to catch up. When the difference between those two gets significant, there'll be buy or sell programs. Now, that doesn't really concern us. I'm just saying this to explain why the jelly roll is going to work, and you'll see that in a minute. But here, for example, we saw a bubble or a blip where the E-mini futures ran up, but the cash didn't catch up quick. So what happened? Traders came in, sold the futures, and bought the stocks in the S&P 500. They wait for the thing to go back into alignment, and a profit is made. It's not as complicated as it sounds. It was so easy. I actually used to do this for a living for a short period of time, but it bored me, so I quit. But when they're doing this, and this is big boys doing huge, huge volume, they go out and hedge this stuff. And they will hedge it with either synthetic futures or real futures. And taking advantage of this mispricing, they ideally like to sell the stock. The big profits are made when the market falls because it falls quick. Everybody here knows that when the markets fall, they move down a lot faster than they move up. And that's where the big profits are made on this program trading or basket trading. So the futures fall real hard, and they'll go out and buy the futures and they'll sell the stock. And what they love to do when they sell the stock is also they collect interest on that short stock. So they're making a little extra money. So they go out and buy the futures, they sell the stock, and then the futures expire on the third Friday in the month on the primary month, September, March, December, and June. So what happens if you're short stock and your hedge is a future that expires? Stock doesn't expire, but the future does. Well, they don't want to be just short stock unhedged because that's risky. They're not trying to get into the risk game. They're getting into the arbitrage game. So what they'll do is they roll those futures out from September to December, or they'll roll them into what they call, just rolls or jelly rolls, which is they're long the front month. That is about to expire, so they want to be long deltas in the back month. So they'll go out and buy deltas in the back month, sell the deltas in the front month, and just keep the trade going until they can unwind it. Now, what happens there is this creates, when they can't buy enough rolls, it creates an artificial buying. Because if they're short stocks and they can't get their hedge back, what do? They buy stocks. And when did they do it? The third Friday in the morning, when at the exact moment the futures are expiring. So here's an example of how a jelly roll profits. I know you don't know what a jelly roll is yet, but I'm doing things backwards deliberately because this is going to show you why there's an advantage to knowing the jelly rolls. Now, this was the prices a couple days ago when I made the slide and we were going to do this last week. So right before we were going to do this class last week, these were the prices then. Look at the prices there, and I put it up on a spreadsheet. And you're going to see the bid and the ask, the mid price, and the ask price. This is important in understanding what I'm about to show you. And I'm going to go real quick. It's going to sound complicated, but it's super simple. Most of the time, let's just look at Apple, for example. Apple, you'll see the bid is 230.67 at 230.69. The mid price is 230.68. In normal market conditions, you expect the market to go back and forth, and the average price will be about 268. But if news came out that was extremely bullish and everybody started buying, everybody would jump in and two six pay 69, not to miss the trade. It'd probably go to 70, and then people pay 70, and then they pay 71, etc. Now, most of the time during the open, every single day, there'll be a bid and an ask on every single stock. They'll be a lot wider than this, and they'll open up usually on average at the mid price. Maybe Google opens up at the high near the ask because people wanted to buy it, but there was some bad news on Nvidia, so people start selling the bid. Tesla is kind of indifferent, so it'll trade in the middle, let's say 349.15, etc. But if you look to the right hand side at the bottom, you'll see the mid and the ask highlighted. If these stocks all trade at the mid price, the opening price on this basket would be 25, 26.58. And if you want, I can annotate it. Right
Super.
here. If there was an artificial demand to buy stock at the open, let's say Morgan Stanley, Goldman Sachs, all the big firms realized they made a mistake the night before or had stuff expiring they had to replace and just bought at the market because they didn't want to waste time. Buying at the ask prices instead of the mid price gets a completely different number. Okay, now this phenomena is what happens typically on the third Friday of every single month, where all the trades just start going off at the ask price instead of the mid price. And then we find out later on, after all 500 stocks open up, what the settlement price is. That comes out as a number called set. And you can see, for example, Meta 248.34 versus 748.34 versus 748.66. The mid price is 748.50, but the ask price is a little bit higher. You do that with 500 stocks, and you've got a big difference. Okay. Now, ideally, what's going to happen? Friday morning, as I explained, we have artificial demand to buy stocks. And I know this sounds tedious and boring and a little bit confusing, but when you see the math in a minute, that's pretty straightforward and simple. By looking at a graph, your eyes are going to open up. Ideally, what we want to have happen is this artificial demand comes in, the market skyrockets, and then once all the stocks are bought right at the moment of the market opening, then the parachute opens up and the market wants right back down to where normal should be now that the artificial buying is evaporated. And the difference between the apex of that rocket and when the chute opens up thousands of feet lower is the profit. For example, once this market starts wafting down because there's no more artificial buying, usually takes a minute or two, profits are made. Now, how do we do this trade? What is the construction of a trade that would make money based on this theory? Well, ideally, we'd like to have a call that expires at the open, the SPX AM options, because when the market opens up at the high of the day, we want that call to close out. We lock in our profit and boom, The short call, acting as a hedge, is still open in the PM expiration and loses value on the way down. We can't do that though, because for us to buy a morning and sell an afternoon is no different than us buying an, a, a Wednesday option and selling a Friday option. The broker's going to consider that the sale of a time spread and the margin is going to be crazy. Whereas buying time spreads are simply the difference between, or simply, well, usually the debit. Okay. If you buy a time spread for 10 cents, that's your margin. You sell a time spread, it's going to be half the value of the stock. So we can't sell a time spread in the SPX because it's just going to be margin crazy. So instead of selling a call time spread, why not buy a put time spread? So what we do is we'll go in and buy the afternoon put, sell the morning put, and we'll do it deep in the money. And when we sell a deep in the money put, let's say 100 deltas, is that not acting like long stock? When you buy a put, you expect the market to go down, so it has negative deltas. But when you sell the put, it has positive deltas. If the put is so deep in the money that it's 100 delta, as that short put has a positive 100 deltas, it's acting like stock on the way up. As the market goes up, that short put is getting cheaper and cheaper. Hopefully it goes to zero and you can buy back for zero. The settlement comes out, and then what's left? The rest of the day of trading, you're long a put. You're long the afternoon put, and the market wafts back down, and you can sell that long put out at any time. So we buy a put time spread where the long is short deltas after the open, and the short put is long deltas in the morning. And ideally, what do we want to have happen? Well, you can do this 2 weeks, 3 weeks, 4 weeks before the actual expiration because it's going to be acting as a time spread and it's going to be relatively inert. But once the bell rings, what happens? Hopefully the market jumps higher. And once that bell rings, 8 o'clock Chicago time, 9 o'clock New York time, bing, 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 your AM options are frozen. You can't do anything because you're just riding out the settlement to see where it settles. And that option is essentially dead. And you're left with a naked long put. And as the market goes down after the artificial buying dries up, you're left with a profit. Another way of looking at it is this: 8:30, the bell rings in Chicago time. So step one, you anticipate the market opening at the high today because we know the big firms have artificial buying to do. And if you don't think they have artificial buying to do, just look at the close, yesterday. Let me come up with that. Whoops. I hate when they. Okay, here's a chart. Let's look at yesterday. Let's look what happened right at the close yesterday. We jumped from 64.20 to 64.50, 30 points in the SPX in the last 30 minutes. That's huge. That's all big boys. That's not mom pop. There was artificial buying coming in. 8:30, we're expecting the same thing on a Friday morning because the guys long E-minis, their long futures are expiring and they have to replace those long deltas or buy their short stock back. They go in and buy their short stock back. And what happens? The bell rings. Our short put, we want to expire at the highs of the day because it's going to be closing at the lowest price. Now, there may be a delay buying the put or put spread if we didn't come in with a trade. If all you know is Friday morning, there's going to be artificial buying. You may want to time getting short the market and buy a put then, but there may be a delay in buying your put, or you may miss the trade. You don't even know what the high of the day is going to be, so you may get a less than perfect put purchase. That's why we do this as a package, because we're not making or losing anything until the bell rings. And then once the bell rings, by having this on as a package, we're automatically long our put right at the bell. Now, from there, ideally, we'd love to have a long call expire at the dead high of the day and then settle at the high price. And that's where the AM would be a benefit. But again, we can't do calls, so we do puts instead. Then we know if that's going to be the high of the day, we want to be short deltas on the way down. And that's where we want our long put in the afternoon to start making us money. So we make money on the way up and we make money on the way down. Because of margin, we can't sell at call time spread, so we do it with puts. Here's an example. Everything was technical up to now. If you just are overwhelmed, refresh your brain. Just don't don't get too worried. It's going to start making sense right now from a common sense point of view, but I needed to get the technical done first. Here's Friday, July 18th. Thursday night on the left, Friday on the right. Look at the high of the day. What is the high of the day in the SPX on Friday? The high of the day was 63.15.61. Can everybody see that? Okay. Now, the settlement price that came in. Remember, I said the settlement price is going to be the opening price of every single stock in the S&P 500. Just the opening print, not the bid ask, not the range, the opening price. When there's an opening price at all asks, it creates an artificial high price. And I'll say, let me mute this. It creates an artificial high price, which is the set. Here, the settlement, whatever we had expiring in the SPX AM options is going to settle at that settlement price, 63.23.58. Look at the settlement price where we sold our long calls or closed our short puts. In other words, you're sold a put, it settles at 63.23. Now you're long a put. And what is the highest price you can buy your short put back at? Or your, excuse me, let me say it this way. Make it a little bit more clear. Let's do it with calls, even though we can't do it with calls. It'll make more sense. We're long an AM call that settles with the stock at 63.23.58. Now we're short a call we have to buy back. What is the worst possible price we can buy that short call back? 63.15. The difference between those two is a profit. In this case, it's almost $8. If you had to buy your short call back and you sold it, or let's say you did it with futures. Let's say you did this with futures and you sold your futures at 63.23.58, the settlement. What's the worst price Friday you could have bought them back at? The worst price. The worst price was 63.15.61. And if you waited 2 minutes, 3 minutes, 4 minutes until the parachute opened and let the market waft down a little bit, you got even much better. Well, we did this. Well, let me show you another example. Okay. We already covered this, so let me skip this again. Let me give you another example, and I'll come back to this slide. Here was August. This was last month's third Friday of the month expiration. Settlement came in at 64.8611. The high of the day was 64.8134. So we are selling our deltas at 64.8611, the settlement, and buying them back any price we can. The worst possible price you could have bought it back was 81.34. And you'll see that if you waited just a minute, after the parachute opened and the rocket fell a little bit, we're buying it back at 78. And literally within the first 5 minute band, you're buying it back near 70. And that's kind of what we did. I'll show you what we did. Let's see. One contract, we made $1,686. So we made $16.86 or almost $17. So if you go back here, where did we do this whole thing? Let me get my annotation pen correct. No matter what, we're selling 64.86, which is about $5 higher than the high of the day. If you panicked and just bought your deltas back immediately, you paid this and you made $5. By the time we got our order up, ready, and entered into the pit, we were about $17 lower, or 64.70, which is right about here. That's where we bought our deltas back within the first couple minutes of trading. And we did it as a group online. We did this. I showed you July. I showed you August. Before that was June. Before that was May. May was $8. Worst case scenario. Here's $5 worst case scenario. July we saw was $8 worst case scenario profit. After this, people went nuts. It's a little complicated to understand at first for some people. It's really not that complicated. It's just more moving parts than you're used to. But the problem is we're kind of doing things backwards. I think most people would have a clear understanding if this was call time spreads instead of put. The other problem is when we're dealing with puts, what happens? We have a problem called ghosts. If we sold a morning put and bought an afternoon put, the AM option is going to be that you sold, even though it expired right when the bell right when the bell rings, it expires. You can't close that trade out because it may take half an hour for them to come up with the settlement price, and they can't take the AM option out of your trading account until they know what price to take it out at. So you sold a put, it's closed, it's not really there, but it's still in your account because your broker doesn't know what price to close it out at until the settlement price comes out. And the settlement price may not be out for a half an hour. So it's not alive. It can't make or lose any money, but it's not out of your account yet. So it's kind of a ghost. Now, the problem is you want to sell your long put. The market just sold off after the bell rang. 15, 16, 17 points on one contract. You want to lock that in, $17 on one put. When's the last time anybody made $17 on a single option? $1,700, lock it in. The problem is, what happens when you try to sell out your long put, but there's a short put in your account that's not real, but it's still in your account causing margin issues. Once you sell out that long put, you're going to get denied, or you're going to have a high margin because your broker's going to think that that short put is real and still causing risk, even though it's not. That's what the ghost does. So the reason why our students have me walk them through this trade every Friday, every third Friday, I should say, while they're learning this, is to deal with this ghost. Because here the AM option is dead, but it's still in the account because your broker can't take it out for an hour or so. And that's preventing you from selling out your long put at a huge profit. So we have to come up with a way around it. So the way around it is many different ways. We can buy a 100 delta call to lock in our 100 delta put. We've also sold put spreads, wide put spreads, so that you can sell out your big put and buy a garbage put to satisfy the margin requirements. You can buy two E-minis because an E-mini is 50 deltas and a put is 100 deltas. So you'll be perfectly hedged until everything, the AM options are taken out of your account. And then you just close the trade down. Or we can do it with vertical rolls. Now we have four different ways of closing this down, each with its own benefit and its own risk parameters that you can customize. So now it starts getting even fancier. And this is why it takes an entire day to teach this instead of just a 90-minute pod class. And as I said, here we had to buy a garbage put to roll our put spreads down. Another way of doing it is the call method. And that's what we did in August. And we went in and bought back, instead of closing out our long put, which is at the top here. Let me pull up the annotator. Instead of closing this long put down, I bought an in the money 100 delta call. Then what do I have on? What they call a mambo combo or guts. I have a long 100 delta call and long 100 delta short put. The deltas cancel each other out. The difference between these two is 115. So the trade has to be worth at least $115 at expiration. But what's really cool is this. Let's say you got a deep in the money call and a deep in the money put. What happens? You have synthetic strangles for free. Now, I'm not going to go into that mess and detail and stuff, but because that'll take up a whole lot of time. But there's other games that can be played. But essentially, right when the bell opened up, we bought the call for 60.20. We sold it at 42, so we lost $1,700 on it. But we didn't care because the put is where the profit was. Our long put made profit and our short put made profit. Look, remember, we sold the 25 put at 62 because of the settlement. We bought it back for 38.89. The market jumped so high we could buy that back at 38.89. Then we're left with the long put and the market went down. We bought the long put at 62.25 and sold it out 73.80. All those more than make up for the loss on our call hedge, and we make 16.86. And when we initially put the trade on, how much did it cost? The difference between 62.25 and 62 cost us 25 cents to initiate this trade. Okay. And I know it's a little bit complicated. There's a lot of moving parts. And that's why we have to have a mini class. It's not like something we can teach in pot and be done with it. I wish it were, but I've been teaching it for years now. This week, I'll start getting people anxious about the third Friday in September, and they'll start saying, Scott, can we do a jelly roll this month? 3 weeks away, 2 weeks away, they start bugging me about the next month. And the next month, they love it. Why? How often do people make $1,686 on one lots? After this last one, the last three jelly rolls in a row, worst case scenario, if you just panicked and hit the button right at the open, you made $5, you made $8, and you made $8. Our email blew up. I said, guys, you got to start learning this, okay? Because I'm busy Friday mornings. I want to do other trades and stuff. So just pay attention to how we close this down. And people said, no, let's have a mini class on this. And that's how the whole mini class concept came about. We're going to have an entire 8.5 hour day of nothing but jelly rolls, how the process works, why it works. We're going to be talking about synthetics, the call time spread, the put time spread, the ghosts, margins, and the four different ways of closing this down. And believe it or not, it's simple Simon stuff. In 30 minutes, it's complicated and overwhelming. In a day, it's no big deal. And what's another benefit that people are just finding out now is typically the AM options were not allowed to be traded after Thursday's close. Today being Thursday, if this were the third week of the month, after market closes, we couldn't trade the AM options anymore after today's close. And we're stuck writing those options in to tomorrow morning, right on the opening bell. So between tonight's close and the opening bell tomorrow, the options are frozen. But what's cool is a new rule came out starting in September's expiration. Look what arrow, effective September 2025. They are going to be trading the AM options up to 30 minutes before the opening bell. So instead of Thursday night, you're stuck and you can't get out, Friday morning now, up to 30 minutes before the bell rings, you can change your mind. And that's starting this month, which is, it's like it's like being given a mulligan when golfing. Like, you know what? I don't like the look of this. I don't want to do this. I'm confused. I forgot how to do this. You can undo it 30 minutes before the market opens. Now even more blew up. Now we're doing this mini class on the 13th. Why? Because the 19th is the third Friday of the month, and I'm going to walk everybody through a trade. We'll put the trade on, send an email out Thursday. Friday, we'll have a class an hour before the market opens explaining how to close this down. I apologize for the late notice. Okay, this is 2 weeks away. Most of the time I've had these things with Tom. It's been four,
Yeah,
6, 8 weeks
usually less
out.
than a week out. Well,
Yeah,
sometimes less. Yeah.
but this is late notice, and this is my fault. Okay, this is
Mine
my
too.
well,
Mea culpa.
mostly my fault, and I'll explain why. I mean, it's mostly my fault, and it's because I just been tied up with portfolio hedging, which was I think the last class that I did with you, Tom,
Yeah,
six
yeah,
months
I
ago,
remember.
right?
Yep,
Where
yep.
we talked about back in January doing a class on portfolio hedging and teaching people how to trade their portfolios like Warren Buffett. We're buying stocks, selling equity calls that are on the high vol, and using that high vol to buy low vol index options. And then after that, I did a 6 month study because people said, okay, Scott, you're a hot shot. You think you can beat Warren Buffett? You think you can beat the markets by 1% a month every single month? like Warren Buffett does. Prove it, tough guy. So we had a 6 month study that started. Okay, the class was in January. February 27th gave us enough time to get started because I wanted to kind of start right before March. So we were already in. So we started February 27th. Then we did 1 month, March. Guess what April was? Tariff month. The market was down 20%. We were fine because we were hedged. Now, this was a crazy 6 months. I had no idea how much work this was going to be. This was way more than all my other duties combined because we had so many people hearing about this that people that aren't even in our database were signing up. We had people that we know nothing about hearing that I'm managing an account for 6 months, and we got inundated. And it was so many people who had almost no experience with options whatsoever that were lost. And I was answering emails until 2, 3 in the morning some nights. So we just ended August 27th, so last week. Okay, we did well. People are demanding I continue it, but I can't because I'm finishing a book. I want to get the book done by Christmas. So right after Christmas, we'll do it again for 1 year instead of 6 months. But here's our returns. Okay. We made 38.43 in 6 months percent. When this is through the tariffs, this is through a lot of crappy, weird markets. The SPX was up 10.79%. Berkshire Hathaway was actually down in those 6 months. We blew everything away. So obviously, people want us to continue doing it again. But I'm like, I need a rest. I need to finish a book. And because of that, I was kind of late to getting to Tom about the Jelly Roll class. So it's mostly my fault. But when people got $30,000 account and they make 11 grand in 6 months, you
Yeah,
know,
it's nothing to sneeze at.
I had a couple people like saying, well, you should have just bought AMD. Okay, hindsight. Um, First of all, that's not managing a portfolio. That's managing a stock, which is a collar. Most people have more than one stock because this year they like PLTR. Last year they liked Nvidia. The year before that they liked Apple. And they just keep collecting stocks. And now they got 10, 15, 20 stocks. And are you going to do a collar in 15 names? Are you going to go into AMD and buy a put and sell a call? And then go into Microsoft, buy a put, sell a call? And Nvidia, buy a put, sell a call? And as all these things are moving around, keep adjusting 15 different names? Or do you do what Warren Buffett does, throw them all in a soup pot, treat it as an index, because it is an index now, and hedge it with an index and only have one thing to worry about? And you're going to get superior returns. Because I'll tell you what, Warren Buffett's not real great at picking stocks. What was it yesterday? He just blew out of his hinds. It was like a major $35 billion disaster. He just got out of Heinz. He makes mistakes like I do and everybody else does. He's not the world's greatest stock picker. He's the world's greatest hedger of a big fund, but he's not the world's greatest stock picker because I'm not real fond of any of his stocks. And I don't think most of his stocks beat what some of you guys are doing. Um, but obviously, for the last 6 months, I've been kind of busy and answering questions. And then when I finally got done with this, I could finally squeeze in the jelly roll that people have been wanting. And after the August expiration, they really went crazy about it. And they started asking questions. So if you guys got any questions about the jelly roll, there's a area on our website that is starting to go up with all people's questions and answers. And feel free to write Tom or me, and I'll be happy to answer. But any questions so far?
I don't see any.
Okay. I probably just made no sense whatsoever. Everyone's like, I don't even know what to ask because I don't know what he said. But essentially, we get to sell the high of the day, no matter where it is. That's the game. So
Oh, very cool. It's
wow. I
starting
now
pretty
I
soon.
know. Now I know I did a horrible job, Tom. When I do a
Oh,
good when I do a good job, I get a lot of questions.
yeah. I don't know why we had a light turnout today, so we'll probably get more questions when I post it on YouTube and in the library and let people know it's there. Um, but yeah,
Yeah,
it's
no big deal.
looks
No
like a
big deal.
good
It doesn't
class.
matter. There's not even that many seats left. I'm not trying to even sell this. This is more informative. I think we're going to be sold out by the end of the day or tomorrow, anyways, because we're
Okay.
limiting the seats to 50. And the reason I'm doing that is because I'm having that live class as a
All
bonus
right.
class on the 19th. And
Mm,
if I got more than 50 people in there and some people have problems and stuff, it becomes too much for me to be able to answer people's
right.
time sensitive questions. You know what I mean?
Yep. All right. Well, I'll get this posted and maybe get a few more people filling up some of those last seats.
Okay. And, you'll, if anyone does want to sign up and there's a good chance that you may get a notice saying, you're on a waiting list, and the number on the waiting list, typically two or three people have like family issues at the last second and, you know, hospital illness or some other kind of emergency. So even if you're number, the first couple on the waiting list,
Yeah,
good
life
chance you'll
happens to
get you in.
people, right? Yep.
Yeah.
All
So
right. Well, thanks again for coming, and I'll let you know when Gabby and I are heading back to Chicago because we're kind of itching to head back there.
I'm telling you, Pequods in person.
Yeah, the frozen one, still like Gino's East in person, but I've never been to Pequod's in person,
Well,
so
Geno's East in person can't be, argued with. You know,
it's pretty good.
where they butter that crust and it like almost pops or little air bubbles on it that absorb the butter, become little butter receptacles.
Yeah, I think it's over on Superior.
Yeah, the
Yeah,
original one. The
yeah,
others have a different. I think there was some family dispute, and so everybody's got a slightly different
I heard that. Yeah,
recipe. So even though the family, every different one's owned by a different family member, the original one is the original recipe, and that's the good one.
that's the
When
one I
I,
went to back in the 70s. Yeah,
yeah, I mean, they had one open up in Delaware
did they
when
really?
I was living in Delaware, and it closed down within months. Nobody ever went there. It was
Wow,
horrible. You'd
wow,
rather have a frozen pizza,
yeah.
but I would say Pequod's and Geno's is very similar in terms of my ranking on a scale of 1 to 10.
Hmm.
Um, Pequod's is going to be a little bit sweeter flavor, and Geno's is going to be a little bit more wine tasting.
Right.
But
They're both good, I guess.
so if you got a sweet tooth, you're going to like Pequod. And I don't have a sweet tooth. I actually prefer salts and sours and stuff. I don't eat too many sweets, but Pequod's being sweet was still blew me away.
Well, we have to try it in person.
And they got the coolest t-shirts. Next time I'm there, I'll get you a t-shirt.
Okay.
Okay. So eh, they got a Scott logo. I wish I thought of it.
Oh, nice.
Yeah. So,
All right, Scott. Well, you take care, and like I said, I'll let you know. Gabby and I are heading out to Chicago, and we'll meet up again.
okay, great. Thanks so much.
All right, we'll see you. Thanks,
Take care.
Glenda.